Hi everyone, welcome to this edition of Covera Insights. My name is Neelab, and as always, we talk to industry participants and bring their insights to you. We are discussing a category today known as sectoral slash thematic schemes. Joining us for this discussion is Ashish Nayak from Axis Mutual Fund. By way of a quick background, Ashish is an equity fund manager at Axis MF. He has almost 20 years of experience, of which 14 are in the investment management space. He's worked with Goldman Sachs prior to joining Axis Mutual Fund in 2009, where he now manages multiple mutual fund schemes. By training, he's a CFA charter holder, an MBA from XLRI, and a computer science engineer. Welcome, Ashish.
Hi.
So, Ashish, great to have you today for this discussion.
Thank you. Thank you very much for having me. Thank you.
So, look, sectoral funds, as the name implies, would be focused on investing in a particular sector, right? Let's say pharma, infrastructure, transportation, etc., etc. Uh, it would be great if you could shed some light on helping us understand what are thematic funds, though they are categorized the same as sectoral slash thematic funds. So, could you shed some light on thematics?
Absolutely. So in terms of a thematic fund, most of the category that we find that are of the sector of the funds that have been launched in this category are trying to address a particular theme, a particular trend across various industries, across various sectors. Some examples that come to mind in terms of recent launches are the let's say an ESG fund, which is talking about sustainability, and this is very important from a futuristic perspective, and we will find sustainable business models doing much better over a longer period of time across various industries, now be it financials, be it consumers, be it manufacturing, and hence that theme is sort of covering various sectors. The same thing if we talk about technology. There are funds which are built in the technological theme, for example, which try to address various kinds of high tech or disruptive tech growth across various industries. Now that can start from actually IT or technology, which becomes logical, but it also goes all the way even to things like banking, to again manufacturing, chemicals, etc. So these are again a sort of all encompassing, while thematic funds are to that extent much more diversified in nature compared to individual sector funds. And as we know, sectors can have their own cycles. So to that extent, having a thematic fund which covers various sectors sort of makes them much less concentrated, and hence much better in terms of diversification for the investor. Having said that, there are few sectors which are not as well represented in a thematic fund compared to a diversified fund. So that's really where a thematic fund lies in terms of concentration, slightly more concentrated in a diversified pure equity fund, but much less concentrated than a sectoral fund. There are other examples of thematic funds that we can think of, like a business cycle fund. So as we said, sectors individually have their cycles, and hence investing into each one of them through a dedicated fund might not actually be the most low volatile kind of investment for most investors. But if they look at a business cycle kind of a fund which tries to invest into cyclicality across various sectors at various points of time, that gives them the right kind of exposure to these sector cycles in a dynamic manner. So that's where these funds are positioned from an investor's perspective.
Right, right. So that's interesting, and that's sort of uh, sectoral funds, like you mentioned, that when an investor, as a mutual fund investor, if I'm investing in a sectoral fund, means that I'm probably going to take a call on that particular sector,
Yeah.
and if my call goes incorrect in the sense that I'm investing in that sector when it is starting to go down, right? Um, then my investment corpus does face higher volatility and higher risk in that sense. So in general, sectoral funds are supposed to be very risky, right? Because the investor is taking the call on which sector will perform and which
Absolutely.
sector will not. And the last example that you gave, which was of a business cycle fund or a business cycle theme, could you just elaborate a little more, because it sounded very interesting?
Sure, absolutely. The idea of a business cycle fund is to look at medium-term growth triggers, let's say from a 2 to 3 year perspective, of finding high growth across various sectors. And then trying to also look at other triggers like maybe valuation re-rating as well as earnings upgrades. Hold these sectors over the high growth phase in terms of a meaningful allocation, which is a slightly higher aggressive stance compared to a diversified fund, and also diversify across various industries. So not just invest into one sector like infrastructure or construction, maybe go into others like banking and even other manufacturing kind of sectors. And over a period of time, as the sector sort of goes into a maturity phase or a sort of steady state of growth, these funds can probably look at exiting that sector and moving into another sector that can actually do better over a period of time. The other way also is business cycle funds also keeps in mind the overall economic momentum. And if there are certain sectors that are benefiting because of that, for example, if there is an expansionary phase of an economy, a lot of cyclicals can do well. If the global economy is doing well, maybe commodities can be looked at. So those are also the things that business cycle fund will look at. So it's a sectoral approach of investing, which is a top-down approach. And beyond that, once the sectors have been identified, the fund will then choose the right kind of stocks, which is a bottom-up approach of investing. So it's a hybrid approach which combines both the top-down as well as bottom-up investment approach.
So, Ashish, that's interesting to know. But and what you said is that business cycles across different sectors are not really secular. So, fund managers would identify opportunities in these sectors and appropriately shift exposure. Is it right to? Is that the way to think about it, or how does a fund manager approach, let's say, the highs and lows of business cycles, high and low phases of business cycles across different sectors for a business cycle fund?
Absolutely. So there are two ways here. As one way is to look at top down on the overall economy. So when there are times of expansion, there will be a lot of sectors that actually start moving faster, in terms of both their business momentum as well as reflected in their stocks. Compare those will be probably more cyclical sectors across commodities, across capital goods, industrials, and even things like consumer cyclicals like retailers and house builders. Beyond that, we see that once the economic momentum picks up, there is also a move towards banking, financials, real estate, and even NBFCs. And at the end of the day, once the economic cycle is sort of at the peak, a lot of sectors like luxury goods, consumer discretionary start doing better. And eventually, once the slowdown begins, we start seeing defensives like pharma, FMCG, and other sectors like telecom and utilities, which are defensive in nature and very low cyclicality, are the ones that do better in that environment. So that's one top-down approach. Now, there are two difficulties here. One is such kind of approach can get crowded because everybody is looking at the same set of sectors. And second is in an economy like India, there are many sectors, especially if you look at the overall economy, which has moved from largely, towards services, and we have not done much work on manufacturing as a sector, and hence there are many opportunities there which are still in the nascent stage. And those sectors will not necessarily move in line with the economy. There will be many times when, because things like government support and other industry specific factors, such as global sort of structural move in manufacturing, etc., those sectors can get a benefit. The other thing is also, one is import substitution as well as export sort of push that those sectors are going to help with. Plus, we have also what we call as a capex upcycle potentially coming up from the private industries, where many industries, in the last decade have not put up new capacities, and hence will look at addition of those things, capacities in the next few years. So that can also help sort of having sectoral opportunities, and also even sectors that are, in the long term, climate change and other such decarbonization kind of focus. So many such industries will, in these focus areas, will give us new sector opportunities to enter into from a medium to long term perspective, where we can find 2 to 3 year high growth phase, and that's what we will try to keep looking for, in addition to looking at the overall economy and which sectors to look at. So that is a kind of combination which gives us confidence that over a period of time there will be sectors that can keep growing faster, and hence the fund will focus into the ones that are continuously growing faster versus getting out of the ones which have sort of reached a steady state of growth.
Fair enough. Fair enough. So, in a sense, Ashish, what you said, a business cycle fund is like betting on in the India growth story, and
Yes.
which I think most of us would subscribe to or sign up for. So that's great. I would just like to sort of add some subtext to our conversation that thematic funds or sectoral funds are equity funds by definition, by SEBI definition, and they need to have 80% or more exposure to a particular sector if they're a sectoral fund, or 80% or more exposure to a theme if they are following a certain theme. In this, the example that we discussed with Ashish was pertaining to a business cycle fund, but there could be other themes which would define how much exposure, minimum exposure should be there. From an investor's perspective, of course, one should keep in mind your investment horizon. Given that these are relatively more, these kind of schemes are relatively more concentrated as compared to the broader market, or even say an index fund, far more concentrated than a large cap index fund or a large index fund. One should think about their investment horizon and invest according to that, keeping that in mind. So if you're investing for the short term, this is probably not your thing. But if you have a longer investment horizon, say 5 years, 10 years, then you could definitely consider sectoral and thematic funds depending on your risk appetite. And with that, we are ready to conclude our discussion today. Ashish, thank you so much for your insights. If and when we receive any questions from our viewers or our investors, we would reach out to you. And it was great to speak with you today, Ashish.
Thank you so much for having me. It's been a pleasure. Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.